In the fascinating world of trading, there's something called a single candlestick pattern. Just like the name suggests, it's formed by just one candle, capturing the entire trading action of a single day. Now, the interesting part is that this lone candle can be the source of a powerful trading signal if it's identified and executed correctly. But here's the key: when dealing with these patterns, keep an eye on the length of the candle, because it tells us about the range of trading for that day. If the candle is long, it indicates intense buying or selling activity. On the flip side, short candles suggest more subdued trading action. And it's not just about spotting these patterns, you also need to qualify your trades based on the candle's length. It's generally a good idea to steer clear of trading based on short, subdued candles. We'll delve deeper into this aspect as we explore specific patterns in the future. So, keep your eyes on those candle lengths, they might just hold the key to profitable trading. Starting with the Marubozu. The term Marubozu, originating from Japanese, translates to bald. We'll soon understand why it's called that. Now, there are two kinds of Marubozu: the bullish Marubozu and the bearish Marubozu. Before we delve into the details, let's revisit three crucial rules about candlesticks. Buy strength and sell weakness. Be flexible with patterns, verify and quantify. Look for the prior trend. Now, interestingly, Marubozu breaks the third rule. Unlike other patterns that require a prior trend, a Marubozu can show up anywhere on the chart, regardless of the trend. The trading implication, however, remains consistent. Imagine the red candle as the bearish Marubozu and the blue as the bullish Marubozu. These candles are unique and hold some fascinating insights. Let's explore them in more detail. Now, let's uncover the secrets of the bullish Marubozu candlestick pattern. In this unique pattern, there's a distinct absence of both upper and lower shadows, indicating that the low is equal to the open, and the high is equal to the close. Simply put, when open equals low and high equals close, a bullish Marubozu is formed. This pattern signifies a strong buying interest in the stock, suggesting that market participants were eager to buy at every price point throughout the day. The stock closes near its high point, indicating a significant shift in sentiment towards bullishness. The prior trend becomes irrelevant, the focus is on the current day's bullish sentiment. Traders seize this opportunity for potential buying. The expectation is that this sudden bullish sentiment will continue over the next few sessions. A trader eyeing this pattern should consider buying around the closing price of the Marubozu. For example, take a look at the ACC chart, where the encircled candle represents a bullish Marubozu. The OHLC data for this candle are: open equals 971.8. High equals 1030.2, low equals 970.1, close equals 1028.4. It's worth noting that while the textbook definition specifies open equals low and high equals close, there may be slight variations. Rule 2 comes into play here: be flexible, quantify, and verify. With the occurrence of a bullish Marubozu, the sentiment turns bullish, making it an opportune time to buy. The trade setup involves a buy price around 1028.4 and a stop loss at 970.0. Candlestick patterns don't provide specific targets, but we'll address that later in this module. The decision of when to buy depends on the trader's risk appetite. Let's explore two scenarios: the risk taker and the risk averse. Risk taker buys on the same day as the Marubozu is formed, around the closing price. Validation involves checking if, around 3:20 p.m., the current market price is close to the day's high, and the opening price is close to the day's low. Risk-averse buys on the next day, ensuring it's a bullish day. The buy occurs around the close of the day. The disadvantage is a higher buy price and a deeper stop loss. However, the risk-averse trader double confirms the established bullishness. Examining ACC's chart, both risk-taker and risk-averse strategies would have yielded profits. Here is another example where both the risk-taker and the risk-averse trader would have been profitable. Now, let's delve into an example showcasing the advantage of the risk-averse approach. In this chart, observe a bullish Marubozu, clearly highlighted. Here's where the risk-taker and risk-averse strategies unfold. The risk-taker, spotting the bullish signal, initiates a trade, buying the stock on the same day around the close. However, the very next day turns out to be a red candle day, resulting in a loss for the risk-taker. Contrastingly, the risk-averse trader, following the rule to buy on a blue candle day and sell on a red candle day, refrains from purchasing the stock on the next day. By adhering to this cautious strategy, the risk-averse trader sidesteps a potential loss. This example underscores the importance of aligning trading decisions with established rules, emphasizing the nuanced dynamics of candlestick patterns. In the world of trading, what happens when a seemingly promising trade takes an unexpected turn? Well, as I've mentioned before, every candlestick pattern comes with its own risk management mechanism. Let's use the example of a bullish Marubozu to illustrate how this works. In the scenario of a bullish Marubozu, the low of the stock serves as a crucial stop-loss level. So, after initiating a buy trade, if the market moves against you, it's essential to exit the stock when the price breaches the low of the Marubozu. Consider this example at a bullish Marubozu with an open of 960.2, high of 988.6, low of 959.85, and close of 988.5. Both the risk-averse and risk-taker would have considered this a buy opportunity. However, the trade eventually failed, resulting in a loss. The predetermined stop-loss for this trade would be the low of the Marubozu, that is, 959.85. Experiencing losses is an integral part of trading, even for seasoned traders. The beauty of following candlestick patterns lies in having a defined exit strategy. In case the trade goes south, there's a clear guideline on when to cut losses. In this instance, cutting losses by adhering to the stop-loss level would have been a prudent move, especially as the stock continued to decline. It's crucial to remember that while stop losses might get triggered, and one might exit a trade, the market can be unpredictable. There might be instances where the stock reverses direction after you exit. Nevertheless, this is part and parcel of trading, and discipline in adhering to established rules is key. Regardless of the outcomes, staying true to your trading strategy ensures a more structured approach to the market. Remember, in trading, adaptability and discipline are your best allies. Bearish Marubozu, a term indicating extreme bearishness, is identified when the open is equal to the high, and the close is equal to the low. Essentially, open equals high, and close equals low. This pattern suggests significant selling pressure, where market participants sold at various price points throughout the day, leading the stock to close near its lowest point. Regardless of the prior trend, this signals a shift in sentiment, indicating a bearish outlook. The expectation is that this sudden change in sentiment will persist over the next few trading sessions. Traders looking to capitalize on this bearish sentiment should explore shorting opportunities. The selling price is ideally around the closing price of the Marubozu. Consider the chart of BPCL Limited, where the encircled candle reveals a bearish Marubozu. Notably, this candle lacks upper and lower shadows. The OHLC data for the candle is as follows. Open equals 355.4. High equals 356.0. Low equals 341. Close equals 341.7. Minor variations in OHLC figures, leading to small upper and lower shadows, are acceptable within reasonable limits. For a short trade on BPCL, one might initiate a short position at approximately 341.7 with a stop loss at the high point of the candle. It's important to note that setting targets will be addressed later in this module. A key principle to remember: once a trade is initiated, it should be held until either the target is reached or the stop loss is breached. Attempting any other action before either of these events occurs may jeopardize the trade. Staying committed to the plan is crucial. The trade initiation can align with the risk appetite of the trader. A risk taker may initiate a short trade on the same day around the closing, ensuring the formation of a bearish Marubozu. By 3:20 p.m., the trader can confirm if the open is approximately equal to the high, and the current market price is equal to the low. If validated, a short position can be initiated. For the risk-averse trader, waiting until the next day's closing is an option. The short trade can be confirmed by 3:20 p.m. the next day, ensuring it aligns with the first rule, buy strength and sell weakness. In the BPCL chart, both the risk-taker and risk-averse approaches would have been profitable. In the chart of Cipla Limited, the bearish Marubozu pattern has proven profitable for both risk-takers and risk-averse traders. It's essential to recognize that these are short-term trades, requiring swift action to capitalize on profits. In this chart illustrating a bearish Marubozu pattern, the trade would not have worked out for the risk-taker. However, a risk-averse trader would have avoided initiating the trade, adhering to Rule 1. This demonstrates the importance of following trading rules to manage risks effectively. In the earlier part of this chapter, we discussed the importance of considering the length of the candle. It is advisable to avoid trading during a minimal that is below 1% range or a long candle that is above 10% range. A small candle indicates subdued trading activity, making it challenging to identify the direction of the trade. Conversely, a long candle suggests extreme activity. The challenge with lengthy candles lies in determining an appropriate placement for the stop loss. A deep stop loss in case of a trade going wrong could result in a significant penalty. Therefore, it is recommended to steer clear of trading on candles that are either too short or too long. Hope you enjoyed this video. If you have any questions about the stock market, feel free to reach out on WhatsApp at this number. Also, don't forget to subscribe to this channel. I'll be back with another trading strategy video.